$1.8 billion vanished from Bitcoin traders in a single day this year, and it wasn't the market that did it. It was 5 specific mistakes made over and over by people who understood the asset perfectly and still lost years of gains in hours. Here they are, all 5, right now, using leverage you can't afford to lose, selling into a red candle out of pure panic, buying the top because everyone online was already rich, trusting a signal from a stranger in a group chat, and having no written plan for any of it before the volatility actually hit. 272,000 traders got liquidated in one 24-hour window this year alone, most of them long, most of them convinced they had time to react. 62% of retail traders couldn't spot a pump and dump before it wrecked them. Stay with me, because the 5th one on this list is the one quietly enabling all the other 4, and almost nobody treats it as a mistake at all. If you own Bitcoin, or you're actively trading it, at least one of these 5 has already touched your account this year, whether you noticed it in the moment or not. This isn't a beginner's list. Every single mistake we're about to cover has taken down traders with years of experience, real capital, and genuine conviction in the asset. I want to be precise about something before we go further. None of these 5 mistakes are about Bitcoin being a bad asset, and this channel has never made that argument. They're about the specific, repeatable ways human psychology fails under pressure, regardless of how good the underlying thesis is. Here's a distinction worth making clearly before we go any further, because it changes how you should watch the rest of this video. You can hold a completely correct, well-researched thesis about Bitcoin's long-term potential and still lose years of gains to exactly one of these 5 mistakes. Being right about the asset and behaving well under pressure are 2 entirely separate skills, and this entire channel exists because the second one gets almost no attention compared to the first. Every fact in this video is sourced directly, dated, and named before each block. This is not fear-mongering dressed up as education. It's a documented account of exactly what happened to real capital in 2026. I also want to say something about why this video exists in the first place before we get into the specifics. Most content about Bitcoin focuses entirely on price, catalysts, and macro narratives, treating the market as the only variable that determines your outcome. The 5 mistakes in this video all point at a completely different variable, the one sitting on your side of the screen, and it turns out to be the one responsible for nearly every documented case of real, avoidable loss this year. Before we start, here's the sourcing on leverage. The liquidation figures, the leverage ratio data, and the specific dated events in this block come from CoinGlass data reported through Yahoo Finance, PrimeXBT, Femex, and Glassnode-sourced reporting on Bitcoin's futures leverage ratio, all published between February and June of 2026. Every dollar figure is attributed to its original outlet. Mistake 1. Leverage you can't afford to lose. Let's start with the most expensive mistake on this entire list in raw dollar terms. Leverage lets you control a position worth 5, 10, even 20 times your actual capital, and it turns an ordinary price move into either a big win or a total wipeout, with nothing in between. Here's what that actually looked like this year. On June 2nd, 2026, $1.8 billion in leveraged positions got liquidated in a single day, the biggest wipeout of the year to that point, with over 272,000 traders caught in it. Long positions took the overwhelming majority of the damage, $1.57 billion liquidated against just $215 million in shorts. That wasn't an isolated event either. On January 20th, 2026, more than 182,000 traders lost over $1.08 billion in a single day, nearly all of it long Bitcoin and Ethereum futures. 12 days later, an event traders started calling Black Sunday 2 forcibly closed roughly $2.2 billion in positions within 24 hours. Hitting over 335,000 traders. Here's the number that tells you the market was building toward this the entire time. In February of 2026, Bitcoin's futures leverage ratio hit 2.63%, according to Glassnode, the highest level since October of 2025, right before the Black Friday crash that same month. A high leverage ratio means traders are borrowing aggressively to open positions, and it's exactly the kind of fragility that turns an ordinary price dip into a cascading, forced liquidation event. Here's the mechanism in plain terms, because understanding it matters more than the headline number. A liquidation happens when a leveraged position's losses eat through the required margin, and the exchange automatically closes it to stop further losses, whether the trader agrees with the timing or not. On February 23rd alone, a single $61.5 million Bitcoin long got forcibly closed on one exchange, the largest individual liquidation in a 24-hour window, with 93% of all liquidated positions that day being longs. Here's a second event worth walking through because it shows the same pattern repeating at a different point in the year. In early June, Total perpetual futures open interest across major exchanges collapsed 43% in a single day, falling from $217 billion to $123 billion. Market makers estimated the true liquidation total, once undisclosed positions were fully counted, may have approached $30 to $40 billion across the broader crypto market, far beyond what exchange reported figures alone captured. Now, the bear case, because we cover it in every single block on this channel. Leverage itself isn't inherently reckless, and professional trading desks use it constantly as part of sophisticated hedge strategies with real risk controls. The honest criticism here is specifically about undisciplined retail leverage without stop losses or position sizing, not leverage as a category. And lumping every leverage trader into reckless oversimplifies a genuinely more nuanced picture. Here's the line worth remembering from this block. Leverage doesn't create losses. It removes your ability to survive being early. And in an asset this volatile, being early and being wrong look identical for exactly long enough to wipe you out. There's a specific pattern worth naming that repeated across nearly every liquidation event this year. The events didn't happen during quiet, gradually declining markets. They happened after periods of calm, when funding rates sat comfortably positive and traders had rebuilt confidence, right before a sudden move exposed exactly how much borrowed exposure had quietly accumulated underneath that calm. That rebuild and collapse cycle happened at least 3 separate times in the first half of 2026 alone, and the traders caught in the second and third cycles were frequently the same people who'd been liquidated in the first one. Quick mention before we go further, every one of these 5 mistakes traces back to the exact psychological gap the Bitcoin holder mindset ebook is built around, the space between knowing what you should do and actually doing it once real money and real pressure are involved. It's normally $97. Stay to the end, and I'll hand you a code worth $50 off, bringing it to $47. Before the next 2 blocks, here's the sourcing. The panic selling survey data and on-chain capitulation figures come from the March 2026 Bitcoin holder sentiment survey and on-chain analytics reporting from AMB Crypto and Crypto News, previously verified for this channel. The FOMO buying and leverage cycle data connecting to it comes from the same CoinGlass-sourced reporting cited in Block 1. Mistake 2. Panic selling into the red. Here's the mistake that doesn't require leverage at all, and it still destroys years of gains for people holding their coins outright. Panic selling happens when a holder watches a sharp drop, assumes it's permanent, and sells at exactly the moment the asset is cheapest, converting a temporary paper loss into a permanent, realized one. Here's the data on how common this actually is. A survey of Bitcoin holders conducted in March of 2026 found that only 8% qualified as true panic sellers, people who both sold during a downturn and said they'd sell more if conditions worsened. That's a minority, but it's a minority responsible for an outsized share of the damage, both to their own portfolios and to short-term market pressure generally. Here's what that 8% actually did to the market during a real correction this year. On-chain data showed that more than $770 million in Bitcoin was sold at a loss by distressed short-term holders in a single downward move, while longer-term holders overwhelmingly kept their positions intact through that exact same window. The on-chain analysis covering that correction summarized it in one line worth remembering. Weaker hands continue transferring Bitcoin to investors with stronger conviction. Here's the psychological mechanism driving this, because knowing the name of it is the first step toward recognizing it in yourself. Loss aversion makes the pain of a loss feel considerably more intense than the pleasure of an equivalent gain. And recency bias makes the last few days of red candles feel like the permanent new reality instead of one data point in a much longer, historically volatile pattern. Combined, those 2 forces make a temporary paper loss feel more urgent and more real than any amount of documented historical recovery sitting in the record. Here's why this matters specifically for anyone who considers themselves a long-term holder rather than a trader. The 8% who panic sold weren't necessarily new to Bitcoin, and plenty of documented cases involve holders with years of experience who genuinely believed, going in, that they'd hold through any correction. That gap between the intention formed in a calm moment and the decision actually made under pressure is exactly what this entire video and the framework behind it is built to close. Now, the bear case for this block. A skeptic can reasonably argue that weaker hands transferring to stronger hands isn't automatically a reassuring signal. It could just as easily describe capitulation partway through a decline that hasn't finished yet. Nobody, including this channel, can tell you in advance whether a specific drop is the bottom or simply a pause, and treating every red candle as automatically temporary is its own kind of overconfidence. Here's a detail worth sitting with, because it complicates the easy version of this story. Not every seller in that $770 million figure was irrational or uninformed. Some genuinely needed liquidity for reasons that had nothing to do with their view on Bitcoin's future. The mistake isn't selling under any circumstances. It's selling specifically because a short-term price move triggered fear rather than because your actual financial situation or thesis genuinely changed. And those two categories get conflated constantly in the moment. Mistake 3. FOMO buying because everyone else was rich. Here's the mirror image of panic selling, and it's just as destructive in raw dollar terms. FOMO buying happens when price has already run up significantly, social proof is everywhere, and the fear of missing further gains overrides any actual evaluation of risk, often pushing buyers to add leverage on top of an already extended position. Here's exactly how this fed the leverage disaster we covered in. Mistake 1. The same leverage ratio spike that hit 2.63% in February didn't happen because professional desks suddenly got reckless. It happened because retail buyers piled into long positions during a run-up, convinced the move still had room, right before the market reversed. That's the FOMO to liquidation pipeline in a single sentence, and it repeated multiple times throughout 2026. Here's a specific instance of that exact pattern playing out. In late June of 2026, Bitcoin slid from above $80,000 in May down to under $62,000 by early June, and the deleveraging that followed wiped out over $1.1 billion in positions in a single 24-hour window. Traders who bought the May run-up on margin, convinced the momentum was permanent, were disproportionately represented among those liquidated weeks later. Here's the emotional trigger behind nearly every documented FOMO episode. It's rarely a cold, calculated bet. It's watching other people's gains on social media, in group chats, on trading forums, and feeling the specific fear of being the only one left out. That fear is not a minor detail. It's the entire engine driving the buy decision, which is exactly why it so consistently overrides any actual risk assessment. Now, the bear case for this block. Not every purchase made during a rally is FOMO, and dismissing every buy, the dip turn buy, the rip decision, as pure emotion ignores that momentum itself is a real, statistically documented market phenomenon that some disciplined strategies are built around deliberately. The line between informed momentum trade and emotional FOMO buy is genuinely blurry in the moment, and anyone claiming they can always tell the difference in real time is overselling their own objectivity. Here's a detail that makes this mistake harder to catch than panic selling, specifically because it feels good while it's happening. Panic selling comes with obvious physical stress, a racing pulse, a sense of dread, something your body is actively signaling as wrong. FOMO buying feels like excitement, confidence, the sensation of finally being right about something everyone else already figured out, which is exactly why it slips past your own internal warning system so much more easily than fear does. If any of these three have hit your account this year, you're not alone, and that's exactly why this video exists. Hit like so it reaches someone before their next leveraged position. Subscribe, because we're tracking every one of these patterns as the cycle continues. Here's what connects the first three mistakes to the reason this channel exists at all. Every single one of them is a failure of mindset under pressure, not a failure of understanding the asset, and no amount of technical knowledge protects you from a decision made in a moment of panic or euphoria. I see the diamond is the phrase the entire Bitcoin holder mindset ebook is built around. The shift from reacting to volatility with your emotions to recognizing volatility as the exact environment the framework prepares you to hold through. The ebook walks through the specific patterns behind all three of these mistakes: selling too soon, panic selling, FOMO buying, with practical frameworks for recognizing which one you're most vulnerable to before the market forces you to find out. It's normally $97, and the $50 discount I mentioned earlier still applies, bringing your total to $47. I'm not giving you the code yet, because the next two mistakes are the ones almost nobody names, and they're just as expensive. One more sourcing note before the final two blocks. The pump and dump in social media scam figures come from NFT Plaza's 2026 Crypto Scam Statistics Report, Traders Union's 2026 Retail Trader Survey, and ZebPay's 2026 Crypto Scams Roundup. All figures are attributed to their original named source, and where a claim is survey-based rather than audited data, that distinction is stated explicitly. Mistake 4. Trusting. A signal from a stranger. Here's a mistake that doesn't even require you to misjudge the market, because the game is rigged before you ever place the trade. Pump and dump schemes work by inflating a token's price through coordinated hype, private groups, and influencer promotion, then dumping the organizer's holdings the moment enough retail buyers pile in behind them. Here's how common this actually is, according to a 2026 Retail Trader Survey. 62% of retail traders could not identify a pump and dump scheme before it happened to them, and 38% lost more than $2,500 because of manipulated token prices. That's not a fringe failure rate, that's a majority of surveyed traders walking directly into a scheme they never saw coming. Here's the scale of the delivery mechanism behind these schemes. WhatsApp groups alone facilitated $310 million in crypto theft through bogus trading signals, and influencer-driven fraud campaigns surged 54% in a single year. with fake Elon Musk endorsements accounting for 32% of all social media crypto scam attempts. Rug pulls, projects launched with the explicit intent to defraud and disappear, drained an estimated $1.8 to $2.8 billion from investors in 2025 alone, depending on which tracking firm's methodology you use. Here's a detail specific to how these schemes select their targets, worth knowing because it changes who should feel at risk. 70% of rug pull victims had invested less than $10,000 each, meaning the damage lands overwhelmingly on smaller, ordinary accounts rather than large, sophisticated investors who might have more resources to investigate before committing. That distribution isn't accidental. Smaller accounts are specifically targeted because they're statistically less likely to conduct the kind of due diligence a larger, more experienced investor would insist on first. Here's why this specific mistake deserves its own place on the list, separate from ordinary FOMO. FOMO buying is an emotional overreaction to a real asset moving in a real direction. Trusting a stranger's signal in a group chat is handing your decision-making entirely to someone whose financial incentive is the exact opposite of yours, disguised as insider access or community trust. Here's how these schemes typically get built, because recognizing the structure in advance is the entire defense. Organizers accumulate a position quietly in a low liquidity token, then flood social media, private groups, and influencer partnerships with coordinated hype designed to trigger exactly the FOMO response we just covered in mistake 3. Once enough outside buyers pile in and the price spikes, the organizers exit first, selling directly into the demand they manufactured, leaving everyone who bought on their way in holding a rapidly collapsing position. There's also a newer, more sophisticated layer to this worth flagging specifically for 2026. AI-generated deepfake videos and audio now convincingly impersonate recognizable figures in the space, promising giveaways or guaranteed returns that never existed. And one documented deepfake livestream collected more than $5 million in donations within 20 minutes before it was taken down. The technology making these fakes convincing has improved dramatically even in the past year, which means the old advice of just look for bad video quality no longer protects anyone. Now, the bear case for this block, and it matters specifically because Bitcoin itself is different from the assets driving most of these numbers. The overwhelming majority of the scam figures cited here involve low-cap altcoins and meme coins, not Bitcoin directly, and treating every crypto statistic as a direct warning about Bitcoin specifically overstates the actual risk to a Bitcoin-only holder. That said, the psychological vulnerability, trusting unverified social proof over your own judgment, is identical whether the asset being pumped is a meme coin or a leveraged Bitcoin derivative product, which is exactly why the pattern still belongs on this list. Mistake 5. No written plan before the volatility hit. Here's the 5th mistake. The one I told you at the start was quietly enabling all 4 of the others. It's not a specific bad trade. It's the absence of any decision made in advance, which means every single decision gets made live, under pressure, with your emotions fully engaged and your judgment compromised. Here's why this one is so easy to overlook as a mistake at all. Leverage, panic selling, FOMO buying, and pump and dump schemes all look like discrete, isolated events when you list them separately, each with its own headline and its own dollar figure attached. But every single one of those 4 events happens to people who never decided, in advance, what their leverage limit would be, what price drop would trigger a review instead of a panic, what personal rule would keep them out of an unverified group chat's signal. Here's what a written plan actually replaces in the moment that matters most. Without one, the decision to sell, buy, or add leverage gets made in real time, with adrenaline elevated and the price chart flashing directly in front of you, which is precisely the physiological state least suited to sound judgment. With one, decided calmly in advance, the same moment becomes a simple checklist. Does this match a rule I already set, or doesn't it? Here's the uncomfortable truth connecting this back to every case we've covered on this channel before. Laszlo Hanyecz didn't have a framework because none existed in 2010. Marty Malmy understood the technology better than almost anyone alive and still had no plan strong enough to survive an ordinary financial pressure. The 8% of panic sellers in this year's survey, the 272,000 liquidated traders in June, the 62% who couldn't spot a pump and dump, none of them lacked information. They lacked a decision made before the moment that needed it. Here's what a specific, written plan actually contains in practical terms, rather than as an abstract idea. It names a maximum leverage ratio you will never exceed, regardless of how confident you feel in the moment. It names a specific percentage drop that triggers a calm review of your thesis, rather than an automatic sell order. It names, in advance, that any unsolicited message promising guaranteed returns or insider signals gets deleted without a response. No exceptions, no matter how convincing the sender seems. Here's why writing it down specifically matters more than simply having a general idea in your head. A plan that exists only as a vague intention gets renegotiated in real time, under pressure, by the exact same compromised judgment that caused the other 4 mistakes in the first place. A plan written down in advance, ideally reviewed when markets are calm rather than drafted in the middle of a crisis, becomes something you can check yourself against, rather than something you talk yourself out of the moment it becomes inconvenient. Now, the bear case for this final block, and it might be the most honest one in the entire video. A written plan doesn't guarantee a good outcome, and no framework, including the one in the ebook we're about to talk about, can predict where Bitcoin's price actually goes next, in either direction. This channel does not make price predictions, and a plan's value isn't in forecasting the market. It's narrowly in improving how you behave, once the market does whatever it's going to do regardless of anyone's plan. 5 mistakes, 5 real dollar figures, all documented from 2026 alone. Leverage that liquidated hundreds of thousands of traders in single days. Panic selling that converted temporary losses into permanent ones. FOMO buying that fed directly into the same leverage disaster. Pump and dump signals that a majority of surveyed traders never saw coming. And underneath every one of them, the absence of a decision made before the pressure arrived. None of these 5 require a lack of intelligence, and none of them are unique to beginners. What they require is the exact gap this entire video has been describing, the space between understanding an asset and having a tested personal framework for behaving well when that understanding gets tested by real volatility and real money. Here's one more thing worth noticing before we move into what to actually do about all this. Every single one of these 5 mistakes was fully preventable using information that already existed, publicly, before it happened to each individual trader. The Glassnode leverage ratio data was public before February's crash. The survey data on panic selling was published before the 8% acted on their fear. None of this required insider access. It required someone actually building a framework around information that was sitting there the entire time, freely available to anyone willing to use it. Let's be honest about where you actually are right now, because that's the entire starting point. You've watched 5 documented dollar-verified failures this year alone, and if you're honest with yourself, at least one of them has already touched your own decisions. This year, maybe this month, that's the situation, and pretending otherwise wastes both of our time. Here's the problem underneath that situation, stated plainly. Every one of those 5 mistakes gets made by people who already know, intellectually, that leverage is risky, that panic selling locks in losses, that FOMO is dangerous, that unsolicited signals are usually scams. Knowing it in the abstract and actually behaving differently at 2 in the morning during a 7% drop are 2 completely different skills, and almost nobody trains the second one deliberately. Here's what that gap actually costs if it stays unaddressed. It's not a one-time loss you absorb and move past. It's a pattern that repeats every single cycle because the market keeps generating the exact same pressure again and again, and an untrained response to that pressure produces the same outcome every time it shows up. 272,000 traders didn't make a mistake once this year. Many of them made it multiple times because nothing about their decision-making process actually changed between events. Here's what changes once that gap actually closes. The Bitcoin Holder Mindset ebook exists specifically to build the second skill, the one that has nothing to do with understanding the asset and everything to do with how you behave the moment real pressure arrives. It walks through the exact 5 patterns in this video, with practical, specific frameworks for recognizing which one you're most vulnerable to, and a concrete plan you can write down before the next drop, the next rally, or the next unsolicited signal ever reaches you. Think about what that need payoff actually looks like the next time one of these 5 moments arrives, because that's the entire point of building this in advance rather than after the fact. Instead of watching a red candle and feeling your pulse spike with no framework to check it against, you have a specific written threshold that tells you whether this is a genuine review moment or simply noise, instead of a group chat signal landing in your messages and triggering the same social pressure that's already cost other traders hundreds of millions of dollars this year. You have a standing rule that makes the decision before the message ever needed a response. Here's the offer, and I want to be direct about the value on the table. The ebook is normally $97, priced for what it actually replaces, hours of hard-won trial and error that cost the people in this video real documented money. Use the code HOLDER50 at checkout, and $50 comes off immediately, bringing your total to $47, less than a fifth of what a single bad leverage trade cost the average liquidated retail trader this year alone. Here's the actual cost of doing nothing, and it's worth sitting with directly. The next leverage spike, the next red candle, the next group chat promising insider access is not a hypothetical. It's a documented repeating pattern that already happened multiple times in 2026 alone. The $47 is not the real cost being weighed here. The real cost is whatever the sixth mistake ends up costing you if nothing about your process changes before it arrives. The link is directly below this video, and the code is HOLDER50 before you complete checkout. This isn't a course you'll never finish. It's a focused framework built specifically around the 5 patterns you just watched documented with real numbers, designed to be read and applied before your next moment of real pressure, not filed away for someday. Here's the question to actually sit with before you close this video. If the next drop, the next rally, or the next guaranteed signal showed up in your feed tonight, would your response tonight look any different than it would have looked a year ago? If the honest answer is no, that's exactly the gap this ebook was built to close. Let's walk through what we covered one more time before we close. Mistake 1, leverage that liquidated over 272,000 traders in a single day this year, fed by a leverage ratio that hit its highest point since the prior year's crash right before it happened. Mistake 2, panic selling that converted a temporary paper loss into a permanent one for an 8% minority, responsible for over $770 million sold at a loss in a single move while stronger hands held firm. Mistake 3, FOMO buying that fed directly into the same leverage disaster, piling into positions during a run-up right before the reversal that liquidated over $1 billion in a single day. Mistake 4, trusting unverified social signals, with 62% of surveyed retail traders unable to spot a pump and dump before it cost them money, and over $300 million stolen through WhatsApp groups alone. And mistake 5, the absence of any plan decided in advance, the gap quietly enabling every one of the first 4 to repeat itself, cycle after cycle, for people who never train the specific skill of behaving well under pressure. Every one of these 5 is documented, dated, and sourced directly from 2026. None of them required bad luck, and none of them required a lack of intelligence. They required a gap between knowledge and behavior that this entire video and the framework behind it exists specifically to close. One final thought before we close this out completely. The specific dollar figures in this video will be outdated by the time the next liquidation event happens, and it will happen, because the mechanism producing them hasn't changed even though the exact numbers will. What doesn't go out of date is the pattern underneath all 5. The gap between what you know intellectually and what you actually do under pressure, and that gap is the only part of this entire equation that's genuinely within your control. If this reframed anything for you, share it with someone before their next leveraged position or their next unsolicited signal. Subscribe, because we're tracking every one of these patterns as this cycle continues to unfold. I'll see you in the next one. This video is for educational and informational purposes only and does not constitute financial advice. Bitcoin and other digital assets are highly volatile. Leverage trading carries substantial risk of loss, and past outcomes referenced in this video do not predict future performance. Always do your own research and consult a licensed financial advisor before making any investment decisions.